Hi everyone, it's Tuesday, August 19th, 2025. Our episode starts with our main headline, Market Leaders Take a Dive. More and more people have been waking up to the fact that when Bitcoin does something, typically the whole market follows it, and so that's why it's become a market leader. It did drop 2.4% today, and it's been dropping. And the stock market has a little catching up to do, it seems. While we're on the subject of Bitcoin, I'm planning to exit my short when we basically this M pattern plays out to the downside around 100,000. This is despite I think Bitcoin will go much lower. This orange line from 2017 when we had the 2021 dip fall much further, 77%. What happened in 24 dip, we hit the line again. I think we're headed actually much lower. I think we're headed for an 80+% drop in Bitcoin. But to get back to the subject at hand, the other market leader taking a dive today was NVDA, confirming below the breakdown of this yellow trend line from the bottom of April connecting to June, suggesting on a pure technical chart that NVIDIA is looking like it wants to head much lower. NVIDIA has become sort of the market, the darling of the stock market that everybody loves so much. Just to remind everybody, it has a PE ratio of 40, and normal, good business, use typically half that. So if competition steps in and, the company stops growing its profits so quickly, or even shrinks its profits because of the competition, you can imagine how far NVIDIA can drop. And considering its size and weight in the S&P 500, this could really become a much bigger event than most people can possibly imagine. But most markets aren't waking up to this yet, but that's what makes the market leaders, right? They move first and then everything else follows. Because meanwhile, this morning, we actually hit a new 28-year record in the AA bond spread. You can find this chart on the Fred. It's AA bonds, so big companies like Walmart, they still have to pay more than the treasury yields, because treasury yields are guaranteed, right? A corporate bond can potentially go bankrupt or miss a few payments if they run out of money. The main point here is that in tough times, sometimes even really good corporations have to pay as much as almost 5% over the yield that treasuries pay out. And right now, it's this morning, actually, we hit 0.41. We haven't seen this rate for 28 years. We haven't seen this tight of a credit spread between the treasury securities and AA bonds since 1997. Remember, it's common to see credit spreads get really tight, including the AA bond spread, before going into major problems. In 1998, we still had 2 years to go before the dot-com bust, but, the credit spreads were widening through that period. Also, before the great financial crisis, things were pretty tight before exploding all the way up to 5%. Even before the COVID crash, they got pretty low, actually lows that we haven't seen for maybe over a decade previously, before blowing out. As soon as you get that black swan event, as soon as the markets are like, things aren't as good and credit spreads widen. But today we hit a 28-year record. I think that's notable. The next headline I wanted to say today was entitlement spending. A reminder. I just want to remind everybody that $1 trillion was cut over the next 10 years for entitlement spending. Entitlement spending has been acting as a tailwind. In other words, something pushing stock valuations higher, stocks higher, because the more people have more money to spend, therefore companies can make more money. When you see cuts like this, especially in entitlement programs, it becomes more of a headwind, something that can slow down stocks and, riskier things, everything, the entire economy. Third item on the agenda, tariff update. Remember, folks, we're still in the tariff game. When the stock market goes down, Trump says, hey, we're not going to do so many tariffs. And when it's high, he's willing to expand 50% steel and aluminum tariffs to include 407 additional product types. I think this all contributed to stock selling off a bit today. While we're on the subject of tariffs and, does that mean inflation's going to go up more? Well, not according to the 5 and 10-year break-even inflation rate. Actually dropped today. I have been saying over the past numerous shows how we've been getting flat, preparing for a bigger move. And so far, that move looks like it's to the downside. The 10-year break-even inflation rate dropping from yesterday's 2.38 to today's 2.35. Today overall in the markets, there was a lot of interesting things going on. I'm going to go through a lot of charts today actually that tie all these things together. Before we get there, community topics. What moves, if any, did you make today and why? I couldn't help myself, bought more HYG puts. Some of these that are only a week or two away, the price is at a place where if you were to buy it and exercise it, you wouldn't lose any money. It's like, or such a small amount that there's no premium. There's no premium on these contracts. They're practically free, the way that I see it. If it drops just a little bit, the sellers of these contracts are going to lose pretty big time. I do not understand how they are this cheap right now. Maybe somebody knows better and can explain to me in the comments, but I'm buying them hand over fist at this point. Another thing I did today was I trimmed my leveraged MSOS position, MSOX. It went up 300%, so I took my cost basis out of it. So the rest of it's free money as far as I'm concerned. And the MSOS chart, as I explained yesterday, looked like it was forming a head and shoulders top, which we clearly broke today. And it still looks like it's headed back down to the scene of the crime where we broke out previously from this inverse M pattern here. Sorry if you can't see it too good, but I do expect this to get down to 338. I might load into it more at that point, might not. If the whole stock market's falling apart by then, this can go a lot lower. But on the other hand, with the rumor being, we might change the schedule of this product, I'm happy to hold onto the entire non-leveraged portion of this at the very least. What did you do today and why? Comment below. Coming up tomorrow, Wednesday, we have Fed minutes released at 2 p.m. What are they talking about over there at the Federal Reserve? We get to get a little bit of an inside look. And then Thursday, PMIs coming out, weekly jobless claims. We also have Walmart earnings coming out before the bell in the morning. This is one of the bigger companies that comes out with some data that can really help investors understand what's going on with consumers, how they're thinking. Their earnings reports in the past have been pretty headline worthy, and I expect this one to be no different. We have Powell at Jackson Hole having his speech come out at 10 a.m. And as always, continuous tariff updates. I appreciate all you guys for watching, subscribing to the channel, commenting, and supporting. No changes to the daily reminders, micro views. Read my website to go through them. No changes to the crystal ball readings nor the Robschild portfolio. On to the charts. We'll start with a heat map today just to show how much of the other leaders are also dropping. It was like all tech, basically. The biggest, dearest companies dropping the most, it seems. The S&P 500 as a whole dropped by 0.6% today. If you remember, we've been talking about the RSI divergence showing a lower high, so it wasn't unexpected by a lot of people. The AA credit spread report comes out in the morning before market hours, and the market kind of dropped during the day. One way to see where credit spreads are going is to take a look at, my favorite way of doing it is HYG divided by SPY, not SPY, SHY. I want to note that while credit spreads, junk bond credit spreads spread a little bit, nothing noteworthy. And so credit markets are currently not really worried at all. Also, the options market isn't very worried at all. Still, notably, the VIX being below 20 and only rising a little bit today. However, we did have a slightly larger move in the VVIX, the volatility of volatility, going a little higher. When the VVIX goes above 105, it's a rising uncertainty zone. And then the VVIX, anything over 120 is, holy heck, we're in panic mode. Gold sold off today by 0.5%, right alongside the break-even inflation rates. And the 10-year Treasury note yield dropped by 4 basis points. So a little bit of a run to the traditional safe haven of U.S. Treasuries. DXY, the dollar index, rose a little bit today. And Dr. Copper with a PhD in economics, it looks like a small dip. It was 1% in copper. This has partly to do, I'm hearing from other people, with overproduction, really, of copper in China. If demand dries up more alongside that, it is pretty obvious that copper is very likely to break lower out of this very clear-looking bear flag. Another chart that really caught my eye today was the ETF URA. This is a uranium index. It's just a really beautiful, perfect looking head and shoulders top that we broke the neckline of today. Valuation wise, I think the uranium miners have been getting a bit pricey, and it wouldn't surprise me to see this market continue to sell off. It's interesting how silver often correlates with uranium, and we have a similar looking pattern here, right? The head and shoulders top, but not yet breaking this neckline yet, but looking prepared to do so. It's worth mentioning the advanced decline line actually rose today, so more stocks actually went up today despite markets seeming like they were really going down. We have yet to see if the market leaders will pull everything down with it or not. So far, not. I also wanted to bring up the put to call ratio. Sometimes it's more clear that the market thinks that the market's going to keep going down when the put to call ratio actually rises. Instead, it's been dropping. So my main headline of the day really nails it on the head. It's the market leaders that dropped today and not much else. But being leaders, maybe we'll see some follow through as early as tomorrow. The last chart of the day I want to bring up is, again, the 10-year minus 3-month Treasury, comfortably exactly at 0. Really the biggest thing I think on most people's radar, and I'm hearing people talk about this, is the Jackson Hole. Just because Jackson Hole is famously and infamously the place where Fed chairs will often come out with a new view of how things are going to operate in the future, with very bubbly looking valuations, a lot of money packed into very speculative, very dangerous things like meme coins, and enormous amounts of growth assumed into some ginormous companies. It's a very dangerous situation. I really think that Powell is going to set a very, very hawkish tone at this meeting. Just to go back to this headline, the expansion of tariffs at this time, right before this meeting, where I think he's expected to be very hawkish. It'll be once again the finger pointing, blaming, oh, you're crashing the market. No, you're crashing the market. The truth is that all powers that be don't want a bubble, because the outcomes of bubbles are really bad. And the bigger the bubbles get, the worse the eventual fallout always is. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.